and welcome to another segment of Accounting 101. My name is Dr. Annette Moultrie, and let's see what we have in store for you in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. Welcome back. We are continuing our discussion on Chapter 9, Receivables. This is Part 3 of Chapter 9, Receivables. The learning objective 9.4, account for notes receivable, including computing interest and recording honored and dishonored notes. We're beginning with learning objective 9.4. So how are notes receivable accounted for? Promissory note. Promissory note is a written promise to pay a specified amount of money at a particular future date, usually with interest. Maker of the note, who is the debtor, is the entity that signs the note and promises to pay the required amount. The maker of the note is the debtor. The payee of the note, the creditor, is the entity to whom the maker promises future payment. The payee of the note is the creditor, and the creditor is the company that loans the money. What is principal? Principal is the amount loaned by the payee and borrowed by the maker of the note. The interest, of course, is the revenue to the payee for loaning the money. Interest is an expense to the debtor and its revenue to the creditor. The interest period. It is a period of time during which interest is computed. It extends from the original date of the note to the maturity date. Also, it is called note term. What is interest rate? It is the percentage rate of interest specified by the note. Interest rates are almost always stated for a period of 1 year. What is maturity date? As we stated earlier, this is the date when final payment of the note is due, also called the due date. Maturity value is the sum of the principal plus interest due at maturity. Maturity value is the total amount that will be paid back. In order for a note receivable to be enforceable, it must be evidenced by a signed promissory note. The note must have 4 primary components. 1, the principal amount. The principal amount must be stated on the face of the promissory note. The interest period must be identified. The interest rate also must be identified. And the promissory note must be signed by the maker. Here in this example, Smart Touch Learning loaned $1,000 to Lauren Holland for 1 year at 6% annual interest. Smart Touch Learning records a debit to notes receivable and a credit to cash for the $1,000. Notice here that interest is recorded only after time has passed, okay? So in this case, no time has passed. So there's no interest yet. There's no interest yet to be recorded. Remember that all interest rates are always stated as annual rates. Some notes specify the maturity date. Other notes state the period of the note in days or months. When the period is given in months, the note's maturity date falls on the same day of the month as the date the note was issued. When the period is given in days, the maturity date is determined by counting the actual days from the date of issue. Here you see here a 6-month note dated February 16, 2025, matures on August 15, 2025, as you see here. At the end of the accounting period, if the note is not yet due, interest will need to be accrued. The approach is fairly straightforward. Of course, amount of interest is equal to principal times the interest rate times fraction of a year that the note has been outstanding. So the formula for computing the interest is amount of interest equal principal times interest rate times time. In the formula, time represents a portion of a year that interest has accrued on the note. It may be expressed as a fraction of a year in months, which is the number of months, divided by 12. Or it could be a fraction of the year in days, number of days divided by 365. Now, using the data in Exhibit 9-4, Smart Touch Learning computes interest revenue for 1 year, as you see here. $1,000 principal times the interest, which is 6%, times 12 over 12. That's for a year. So the maturity of the note is $1,060. It is because 1,000 times the 6% times 12 over 12 is equal to $60. The time element is 12 over 12, or 1, because the note term is 1 year. Let's look at this example when computing interest on a note. When the term of a note is stated in months, we compute the interest based on the 12-month year. In this example, interest on $2,000 note at 10% for 9 months is computed as follows. Amount of interest is the $2,000 times the 10% times 9 over 12, because it says 9 months. So it's $150. The interest on a $5,000 note at 12% for 60 days can be computed this way. Here you see a $5,000 times the 12% times the number of days, 60 days, divided by 365 days, I'm sorry. So the amount is $98.63. Accruing interest revenue and recording honored notes receivable. Refer back to Exhibit 9-4. Smart Touch Learning lends Lauren Holland that $1,000 on September 30th, 2025 for 1 year at an annual interest rate of 6%. On December 31st, interest should be accrued. So the entry will require a debit to interest receivable for $15. And you got the $15 by multiply the $1,000 times the 6% times 3 over 12, right? Because 3, you got 3 from the month, September, which is the 9th month, 3 more months left in the year. For that particular year, that's why you got the 3 over 12 equal to $15. So again, it's a debit to interest receivable for $15 and a credit to interest revenue for $15. For 2026, Smart Touch Learning earns 9 months of interest. 9 months of interest. So how much interest revenue does Smart Touch Learning earn in 2026? That's from January through September. Smart Touch Learning earns 9 months. 9 months of interest. That's the $1,000 times the 6% over 9 times 9 over 12, which is $45. So on the maturity date of the note, Smart Touch Learning will receive cash for the principal amount plus the interest. The company considers the note honored and records the journal entry. On the maturity date of the note, Smart Steps Learning will receive cash for the amount of $1,000 plus the $60 interest. The company considers the note honored and records the journal entry. This involves recording cash of $1,060 with a debit and removing the notes receivable $1,000 with a credit, the interest receivable, the $15 credit, interest revenue, the $45 credit. On July 1st, 2025, Rosa Electric sells appliances for $2,000 to Dorman Builders in exchange for a 9-month 10% promissory note. Here are the journal entries. The notes receivable, of course, the debit, the $2,000, sales revenue is credited for $2,000. Interest receivable is debited for $100. That's the $2,000 times the 10% interest rate times 6/12. Interest revenue is credited for $100. On April 1st, you have cash plus the $2,000 times the interest rate times 9/12. The debit of $21.50, that's when you receive the money. Right, notes receivable is credited, interest revenue is credited, interest revenue is credited. Here in this example, sports club cannot pay blending services the amount due on accounts receivable of $5,000. Blending accepts a 60-day $5,000 note receivable with 12% interest on November 19, 2025. So you see the debit to notes receivable, $5,000, and accounts receivable is credited for the same amount. The interest receivable of $69 is credited, and interest revenue is credited for the $69. That's the $5,000 times the 12%. And this one is over days, 60 days, right? But it's 42 over 365. You have cash, receiving cash, debited for $5,099. Notes receivable is credited. Interest receivable is credited for $69. Interest revenue is credited for $30. If the maker of a note does not pay at maturity, the maker dishonors a note, also called defaulting on a note. Because the note has expired, it is no longer in force. Dishonoring a note is a failure of a note's maker to pay a note's receivable at maturity. When a note receivable is deemed uncollectible or goes into default, it is often first transferred to an accounts receivable, along with any unpaid interest. We then apply our accounts receivable policies to determine when this new accounts receivable will be written off. Suppose Rubenstein Jewelers has a 6-month 10% note receivable for $1,200 from Mark Adair that was signed on March 3rd, 2025, and adhere defaults. Rubenstein Jewelers will record the default on September 3rd, 2025. They will debit accounts receivable for that account of $1,260. Notes receivable will be credited for the $1,200, and the interest revenue will be credited for the $60. Now, even though the note has expired, the debtor still owes the payee. The payee can transfer the notes receivable account to accounts receivable. Okay. Then when this happened, the Rubenstein Jewelers will then bill adhere for the accounts receivable. Now, this allows Rubenstein to eventually write off the receivable using either the direct write-off method or the allowance method, if at a later date, Rubenstein still cannot collect the accounts receivable. Now, this is the end of Learning Objective 9.4. We will begin with Learning Objective 9.5. Use the asset test ratio, accounts receivable turnover ratio, and days sales in receivables to evaluate business performance. This is Learning Objective 9.5. So how do we use the asset test ratio, accounts receivable turnover ratio, and days sales in receivables to evaluate business performance? The balance sheet can be used to calculate various ratios, such as the asset test ratio, the accounts receivable turnover ratio, and days sales in receivable. Here in this example, 9.5, and we talked about Kohl's Corporation throughout the chapters. Here you see Kohl's Corporation partial balance sheet. Now, this company has relatively few assets. Kohl's does not list any receivables on its balance sheet. Now, while the company does promote and accept the private label Kohl's credit card, the card is issued by an unrelated third party. When the company accepts the private label Kohl's card, the sales are accounted for similar to other credit card sales, such as American Express, MasterCard, and Visa. Now, Kohl's has transferred the risk of collecting cash from its customers to a third party. Therefore, we will use a different company to illustrate the calculation of the ratios in this chapter, chapter 9. Again, because Kohl's does not list receivables on its balance sheet, we will use one of its competitors, Amazon. We're going to use Amazon to examine 3 important ratios that include receivables in the calculation. Now, we know that Amazon serves customers through its retail website, and they also have physical stores, and they focus on selection, price, and of course, convenience. The company's accounts receivable shown on its balance sheet relate to amounts due from customers, vendors, and sellers. The asset test ratio is the ratio of the sum of cash, cash equivalents, short-term investments, and net current receivables to total current liabilities. The ratio tells whether the entity could pay all its current current liabilities if they came due immediately. The result is a ratio that gives us an idea of whether the company currently has sufficient liquid assets to cover current liabilities. So quick assets are cash, cash equivalents, short-term investments, and net current receivables. The higher the asset test ratio, the more able the business is to pay its current liabilities. So an asset test of 1.0 or higher is considered safe. Here in this example, you see Amazon asset test ratio as of December 31st, 2018. Oh, again, a cash test ratio is equal to cash including cash equivalents, short-term investments, plus net current receivables divided by total current liabilities. The acceptability of an asset test ratio depends on the industry. Again, we said that the asset test ratio of 1.00 or higher is considered safe. It is not uncommon, though, for retail companies such as Amazon to have an asset test ratio lower than 1.00. Because in this example, we see that the asset test ratio for Amazon as of December 31st, 2018 was at 0.85. The accounts receivable turnover ratio measures the number of times the company collects the average accounts receivable balance in a year. The higher the ratio, the faster the cash collections. Amazon's accounts receivable turnover ratio indicates that the business turns over its receivables 15.61 times a year. So with the accounts receivable turnover ratio is equal to the net credit sales divided by the average net accounts receivable. So in calculating the accounts receivable turnover ratio for Amazon, we use total net sales instead of net credit sales. This is because most companies don't report the level of detail needed to determine net credit sales. The days sales and receivable is the ratio of average net accounts receivable to 1 day's sales. Okay. The ratio tells how many days it takes to collect the average level of accounts receivable. The length of the collection period depends on the credit terms of the sale. For example, sales on net 30 terms should be collected within approximately 30 days, right? When there's a discount, such as 2/10 net 30, the collection period may be shorter than 30 days. Credit terms of net 45 results in a longer collection period than 30 days. However, the shorter the collection period, the more quickly the organization or the company can use its cash. Here in this example, Amazon days sales and receivables can be computed as days sales and receivable is equal to 365 days divided by accounts receivable turnover ratio. So on an average, it takes Amazon 23 days to collect its accounts receivable. However, this figure is somewhat misleading. We used total net sales rather than net credit sales when calculating the accounts receivable turnover. Therefore, our calculation includes both cash and credit sales. Okay, this is the end of chapter 9. This is the end of chapter 9. Thank you for watching. And please, if you haven't already, please click the subscribe button below.